It's been 50 years since the beginning of the 1973 war involving Israel, Egypt and Syria. The conflict, known as the War of October, lasted only 3 weeks, but sparked an oil crisis which dragged major economies around the world into years of stagflation. Today, investors are worried that the fighting in the Middle East might disrupt the global economy again and even see it tip into recession. The concern comes as Israel intensifies its bombardment of the Gaza Strip after declaring war on Hamas. It follows Saturday's unprecedented attacks on both sides of the border between Gaza and Israel after Hamas launched thousands of rockets and sent hundreds of fighters into Israeli territory. On Monday, oil prices surged on fears that the conflict could spread across the Middle East, which is home to almost a third of global supply. Global benchmark Brent crude rose more than 4% to as much as $88 a barrel, while US West Texas Intermediate traded at over $85 a barrel. Natural gas prices have also been rising over the past week. Dutch front-month gas, Europe's benchmark, jumped 15% after the Hamas attack before giving up some of those gains. Investors, as always, flock to safe haven assets such as gold and the dollar. On Monday, the precious metal gained as much as 1.7%, marking the biggest advance since May. The dollar also strengthened against most of its major peers, while risk currencies such as the Aussie and the Kiwi weakened. The greenback extended gains on Thursday after data showed US consumer prices surged more than expected in September. And the conflict came at a time when global financial markets were already grappling with the effect of higher interest rates and slowdown in China's economy. The increased tensions so far have had a limited impact on markets amid dovish messages by the US Federal Reserve and European Central Bank. Global stocks initially fell Monday morning, but recovered throughout the week as investors remain in a wait-and-see mode. For more on this now, Fiona Cincotta joins us from London. She's Senior Market Analyst at City Index. Thank you very much for being with us. Right, Fiona, we've seen crude being very volatile this week. The initial spike we've seen when markets reopened on Monday essentially faded away, but now oil prices are rising again. Is this indicative of the fact that at first markets thought this conflict and these events in the Middle East would have been contained, and then investors essentially changed their mind? What's happening?
Faisal, thank you very much for having me. Great to be here. Yes, so we did see that knee-jerk reaction as markets opened on Monday, where oil prices shot higher. Then we saw that reassessment. We had some calming words from the energy minister in Saudi Arabia, who said they still support the oil price stability, and that seemed to calm the markets. But what we've seen as the week has progressed is that there is a sense that the conflict is escalating. And whilst right now there doesn't appear to be any involvement of oil-producing nations, there is a concern that should this conflict continue to escalate, there is a risk that oil-producing nations will be drawn in to the conflict. And that would suggest then that we could have problems with supply. Now, as a result, there is this sort of geopolitical premium which is being priced into oil and has pushed oil prices higher. And then we've also got today news from the US that they will be tightening sanctions on Russian oil exports as well. So that just adds into this mix and these concerns of tight supply in the oil market.
Right. On the other hand, equity markets seem in a way to have completely ignored the crisis at first. We saw somewhat of a muted reaction. Do you think that will change moving forward? As you said, there are now signs that the conflict is indeed intensifying. Unfortunately, what do you expect the reaction will be in equity markets around the world?
So there's quite a lot going on in equity markets at the moment. I mean, the US, for example, it's very much been focused on dovish commentary that we had from Federal Reserve officials at the beginning of the week. There's optimism surrounding a potential dovish pivot from the Fed, which would be very supportive of equities. And then on the other hand, we've also got US earnings season, which is just starting, which equity markets are also focusing on. And then we've also got this prospect that actually the safe haven flows for the risk premium, if you like, for the conflict in Israel seems to be pulling treasury yields lower. So we've seen a demand for treasuries actually rise, and that reducing or the falling of treasury yields is supportive of equity markets. So it's quite an interesting dynamic that's being played out. But as you pointed out, equity markets have actually rallied across this week, but actually paying more attention, I think, to the fact that the Federal Reserve could be heading towards a dovish pivot.
Right, that's true. And Fiona, you touched on that in your answer. You did talk about safe havens, but are investors now flocking to safe havens? And if yes, which asset classes are of interest right now?
I think the clearest sign that we've seen of safe haven flows this week has been towards gold. Gold's had a phenomenal week. It's trading much higher today. It traded a lot higher across the week. I think we're looking at over 4% gains across the week. Now, that's sort of a mixture of factors playing in there. You've got the safe haven flows for the conflict in Israel. You've also got the prospect of a dovish pivot as well, which has boosted gold. And then we've also got those treasuries, which have seen demand increase, pulling the yields lower, which again is very supportive for gold prices. So I think as far as safe haven flows are concerned, gold has really been an outperformer this week, but we've also seen demand for treasuries pick up.